What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming events, some earnings, anything I can see that has potential to change or pivot the market throughout the week. If that sounds like something you're interested in, consider subscribing, as I do provide daily and weekly updates to get you prepared for the day and the week ahead in this glorious market. Now, let's bring up some stuff. So we are in currently holiday mode. Gonna go ahead and throw this up here. Zoomed in a little bit more so it wasn't so hard to see. Hopefully that does help you guys. But nonetheless, I wanted to kind of go over what we saw last week, some important takeaways from last week. I think it's always important going into the next week. Some potential pivotal events that happened last week that we need to keep an eye on going into this week. So first off, the market is closed on Monday. Obviously, today is Christmas, so Merry Christmas for those people out there and getting ready for the new year and Happy New Year. But the stock market will be closed on Monday, so we will have a short week. Again, that would be very low volume going into the new year. But what we've seen over the past throughout this past week and even during Thanksgiving, low volume. There's still been some really volatile moves to take advantage of. But nonetheless, if you aren't used to volatility, you do need to be very careful as it could go against you very quickly. But one thing I do like with volatility is that this volatility seems to be sticking a bit, and that's my best kind of volatility. I don't like volatility that moves within about 20 minutes and then ends up wicking and then shoots back the other way, which we've had a lot of that this past year and it's faked a lot of people out. But ultimately, what are our takeaways from last week? Beginning of the week, there was a lot of manipulation with the yen in the beginning of the week. Yes, we have to understand that we are in a debt system, and that the bonds play a huge role in the way everything essentially functions in our financial system. And we have to understand that why the yen is so important is because Japan owns a lot of bonds, and they essentially came out on Monday and they said that, hey, you know what we're going to do? We're going to essentially hedge 50-50 both sides of the yen because they are trying to increase the strength of the yen. It's something we've seen a couple months ago. This same manipulation has been occurring. Has happened with Bank of England as well. They have been manipulating their bonds to try to keep up with the dollar, even though the dollars came down. The dollar has been sitting and pretty consistent, roughly around that 104, maybe consolidating for the next move up. But one thing you have to understand is still very high and it's still crushing other countries. There's still massive amount of inflation in other countries that they are dealing with. Here, things seem to be getting better, but we have to also understand that food is still very expensive and rent is still very expensive from what I can see. A lot of the housing stuff is playing out as expected. Consumer debt is increased, right? At one point, a lot of people got out of debt with the free money that everybody was getting. And then now the current situation and inflation has put everybody right back where they left off. So this is why earnings are big, and something again I keep pointing to that we're going to have to start watching. And we got about another 3 weeks before earnings, before the banks kick off, and the banks have already kind of alluded to some really bad stuff coming up. Especially they're expecting negative GDP and things to get really bad. Again, they can see a lot of the credit card statements. People are accumulating debt at a very rapid pace, which is not good, because they won't be able to get out of that debt. People are in hopes of potentially free money again, which is something that's been talked about many different times. But again, we have to see what's about ready to happen. But the other takeaway we had over the past week was, in getting back to the Japan and yen, that's something we have to watch, right? That's something that's been going on for quite a while. It always happens, especially when the dollar starts running up. So we have to pay attention to that and see, because that could buckle a lot of different things, cause a major black swan event, and cause the whole market to just crater. And then on top of the bonds and the issues there, and people try to stabilize their currency so they can stay essentially running with the dollar. You had FedEx that reported. Now again, their earnings, their expectations are really low, so the stock held over the past week, which is good. But again, they're trying to make $1 billion in cuts as well. So again, there's still a lot of issues that you can't be blinded by. I think people are starting to understand that we are in a recession, we have been in a recession, and potentially even a depression. So it just depends on how you define it at this point. But if a lot of people are saying we are not even in a recession yet, so we don't even know what that looks like, and to see what that's going to be like is we're going to be really, really bad, because I know we are seeing demand destruction as we speak. So we had the FedEx deal this week. We had initial jobless claims, which are getting worse, and then we had PCE, which is things are getting better, which means worse, right? So it's most data, you can almost say if it's good, it's going to be bad, because if it's good data, that just means that the Fed can continue to raise rate hikes, which is what concerned people a lot this week. The initial jobless claims again weren't good. We have to understand that we got a lot of people on severance packages. It's something I've been talking about for quite a while. They will start rolling off here in the beginning of the into this first quarter of this year. We'll start seeing a lot more layoffs. We'll start seeing those numbers really get inflated. Be a lot of weight in non-farms, and to see how they start rolling off. We may not see it in this first one in January, but February would be where I'd really be focusing on. Now, naturally, right when we get into January, we typically get into an earnings rally, the Christmas rally, which is one of the most biggest rallies of the year, and followed almost quickly by a sell-off, a normal sell-off, February, March, which I think is going to be it's going to have a lot more fuel. I think the things that I've been talking about, something's about ready to break. I think the Fed will continue to raise rates, even though it maybe only 50 points, 25-point basis moves, which we will get our first one here in the new year in February. They'll continue to hike rates, and then they will again hold those rates at a prolonged period of time, which continue to bring demand destruction into the markets and cause a lot of things to crater. We're seeing a lot of people sell assets that are not homes yet. We have to also understand that a lot of people, I think it's like 60% of the population, their wealth is, or it may be even more than that, is tied to their house, their home, and the equity in their home. And we notice that a lot of people have been taking HELOCs on their home. A lot of people are underwater right now. People trying to build equity to sell their home. The question is the demand going to stay there, or is the demand going to go away once people start rolling off? People can't get jobs. It's just naturally that time of year for people to be spending at this point. So earnings will be important to see. Again, expectations, you have to understand people pulled a lot of expectations. People grinded expectations down to the dirt. We also did have Micron earnings showing chips are very exposed. What does that mean? Is your cloud, all your tech is going to be hit again extremely bad coming into this next earnings cycle. This is why the techs just absolutely plummeted to the back half of the week after Micron. So that's something else we got to keep an eye on going to this earnings. Now this coming week, again, like I said, it's going to be a short week, low volume, not really a lot of anything going on. Thursday, initial jobless claims. Again, when there's not a lot going on, things like this are going to have a little bit more weight. Well, especially now more so because of the fact that we are trying to gauge where the consumer's at and how much more. I think the market is understanding that the shift on the consumer is extremely important because of the fact that we've kind of taken care of inflation to an extent. As long as it doesn't start creeping back up, the next logical step would be to, okay, well, where is the demand at? Where's the consumer at? And that's kind of what we're looking at. So the initial job claims, I think, are going to hold a lot of weight. If we can continue to miss expectations, that's going to be a very volatile event. We've seen that this past week. And then obviously monetary policy, the first one will be February, and it's good to keep this schedule, just kind of watch and see what's coming up. Again, monetary policy will be extremely important, especially to when they stop raising rates. If they hold rates at a specific time, we need to try to figure out when that is, or how that's going to go about. If they continue to raise rates and just continue to pile on, even if it's only 50, 25 points, the rates are still already very high. They're thinking they'd probably stop around March, would be the last rate hike, and then we kind of just stay stagnant from June until December. But we're gonna have to see. It really depends on inflation. Maybe we hold in March, and June, February, for some reason, inflation starts kicking back up, and then that's going to be an issue. So you're going to get more rate increases, which we don't want to see. National savings rate, again, this doesn't change much. I don't think you're going to see a dramatic change in here unless there's a dramatic pivot in the market. But as of right now, we're still sitting at 2.4. Again, we're average around 7.3. Again, you can see here something I post every week. I try to keep on all the industries that I kind of watch. Tech, I'm kind of popping Tesla out of here. Tesla is an absolute whirlwind downfall. I do want to try to catch it when it does flip, but the case is it's still bleeding. Just let it bleed and hemorrhage until it's done and then jump back into it. But if I want to keep an eye on Apple as well, BA value, and always JPM just for financials to keep an eye on them. But if you've noticed, again, there's not a big move being priced in this week, which could be great. These are the kind of weeks you can take advantage of for options, because if there is a volatile market and for some reason the market randomly jumps because of jobless claims, you can take advantage of the market in times like this. When there's not a lot of volume, institutions kind of pushing these low volume days, which we saw last week. We sold off pretty heavy, again, on low volume. So that's something that's interesting and a good takeaway from last week. So again, coming into this week, we're not really expecting a lot. Short week. Again, volume's always typically low anyway in a short week. And then now we're in between holidays here and going into the new year. People just kind of waiting and set it up for 2023. We'll see what happens. So again, my biggest thing is to not risk it if it's not there. Again, my moves have been strictly in the morning, and then I typically don't play unless there's another big move. And there really hasn't been a big move after the morning. Typically that first hour and a half, you'll get a big move, and the market just kind of stays flat. So, and that's essentially when the algos kind of take over anyway. And why I don't like to play around that period either, or I don't play options because typically the options get pretty wrecked in the afternoon. So SPX, what I'm looking at here, again, we're holding currently this 3,800. We want to see how they hold that. I wouldn't be surprised if it just kind of bounced around between the 3,800, maybe the 3,900. We did attempt to try to hit it here and then got rejected pretty hard, but we are holding 3,800. I don't expect the market to continue to sit here for long. Maybe just this week we float around here and then potentially get some sort of rally, maybe going back into the new year. It really just depends. If there's some bad news with the bonds or anything like that, any of these black swan events happen that we've been talking about for so long, again, that could give us more fuel to the downside. But we'll see. And we have to also remember that Goldman Sachs is predicting that the market's going to crater to about 3K. So we still got a ways. This is something that's funny. They think we're going to crater down to 3K. I don't think we're going to fall that far. If we do, if for some reason one of these events, again, this is something to keep in mind. Anytime these events like occur like this, because if we go back to the beginning of this year and to the low of this year, right, we've corrected 27%, which is pretty big. But average is 43. And if you go down to at least roughly 30K, that would put us at 43. Some people are even talking 28. Put us roughly around what the average is if we hit around the 28 or close to the 27. My mind, it really depends on timing. All these events will depend on timing. So that is what's important. If for some reason we don't get the right timing on these things, again, I don't know if we'll hit that. I think we could probably come close to 3,200 if we're going to project if there's any kind of crisis. Again, it really depends on the weight of the crisis, and if it's something we kind of foresee, if it's again left field, the left field and not knowing is what's going to draw more panic. If we see and we're aware of what's currently going on, we're in a depression. If that's like officially announced, maybe that can draw some panic. Again, the administration's trying to draw everybody's attention away from the obvious, um, just to try to not to induce panic. Yes, it's not the greatest. I don't agree with it either, but you can't. A lot of times people just aren't ready for real news. You give them real news and they just panic. They don't know how to handle it. So you have to drive the masses in that state. So I understand to an extent, um, not everybody can handle real news because they just don't know how to deal with it. So, being said, we will watch those levels 3,900, 3,800 this week and see what goes from there. The dollar again, this is something I'm talking about. It's starting to consolidate around here. It might go for another breakout. That's the concern. If we do start breaking out, if there is a crisis and this thing does start ripping back up, you're really going to put a lot of stress on the yen, on the Bank of England. If this thing starts ripping back up, it's already hurting other currencies just sitting at 104. So if it starts ripping back up and making a new high, obviously that's going to be a huge, huge problem. Bitcoin, again, it's still consolidating, holding a lot. Again, when you start seeing all different industries and assets looking the same, that is a concern, because normally that means there's going to be a big move to the downside. It just means there's fear in the market, and so you don't want stuff to all start to look the same. And we're starting to see that again. So you're seeing the dollar, you're seeing again Bitcoin look the same. Let's take a quick look at bonds. I don't normally watch the bonds. Bonds again starting to come back down. So it'll be interesting to see what happens with the bonds there. Again, the bonds, you have to understand the bonds can go up, they can go down, they can run in parallel with the market, they can run against the market. But the biggest thing is you have to understand is it really doesn't matter what the bonds do. As long as the bonds aren't volatile, the volatility of the bonds is what creates big moves in the market. So you have to understand that. So that's where these big sell-offs come from in the bonds, is when the bond market is very volatile. That means there's either one, fear in the market, so there might be a lot of selling. So you have to be mindful of that. So yeah, I'm watching that moving forward. So Tesla, again, this thing, people aren't liking Elon right now, just with everything's going on that front. So being said, we're gonna have to really see how Tesla does going forward. But again, for me, I want to be in this when it does churn. If we do start to get some sort of Christmas rally, this thing could really explode. But the thing is, you don't want to catch a falling knife. You want it to start to churn first. Right now, it's just in a free fall mode, and it's already down to 123, which is something I really wasn't expecting. Maybe 150. But it is definitely in a free fall. And again, people are losing. A lot of people are saying institutions and stuff just are selling out of it. They don't think it's going to be what it is. I highly disagree with that. It's still Tesla. It's still a very great company, great energy company. Obviously, when things are down, people are going to just, nobody's like Tesla anyway. So you have to understand that point of it too. And right now, you have to understand that people are liquidating all assets before they sell their homes. They will sell all their stock. They will sell everything that they can to essentially cover whatever costs that they have. This is to include institutions, so they can say whatever reason they want to give about Tesla, but a lot of them held big positions in Tesla, so they're liquidating to cover costs. You have to be mindful of that too. That does play huge into a lot of things that are going on. And so when it comes to Tesla, again, people were making tons of money on Tesla over the past 2 years. Well, maybe not so much this year, but nonetheless, people, even institutions, are liquidating because they're going to need. People are trying to cover because they're expecting. These institutions are expecting a bigger move coming to the new year, so they want that liquidity. They want that money. You have to understand. People and institutions believe cash is king. This is why this whole term cash is king is important, because times like this, it's better to hold on to money and to wait until you know what's going to happen, or you're anticipating that move. You let that move happen, then you get back in. And so that's kind of what I believe is happening with Tesla. And again, the whole Elon thing isn't helping, but I think a lot of with the institutional selling and all the selling of Elon shares, again, doesn't help. That kind of just the whirlwind of selling at this point. So, but I still want to keep an eye on it. Again, there is not really any great support on this thing. You have to look pretty far down. Tesla could drop pretty far. Roughly looking at the 100, it's kind of like that mark. We could hit 114 as a support there, and then the 100, kind of what we're looking at. If it drops lower than that, you're looking like at 63. Potentially even like 43, which is crazy to think. But if it does get that low, you better be guaranteeing I'll be stacking some Tesla pretty heavy at those levels. So, but again, this is what happens in a recession, right? And this is what happens. You're not going to V-shaped recovery like you did over the past 2 years. That was a very historical moment. And I think a lot of people haven't captured the fact that the past 2 years was a very historical moment. It's not typically what the market is. And so, so this is what we're dealing with, and these cycles are normal. We'll get through it. We have to let it play out. It's very painful when it plays out, but we have to let it play out nonetheless. Apple, watching this 130 again. This same thing on this one. This thing can sell off quite a bit. But 130 again, that's a really big support. You really don't want it breaking that. If it does break that, you got some support here at the 122, some additional support here around the 117. But this is why these stocks have done splits over the past year. They're anticipating the bigger move. This is why I talk about earnings and be watching these companies. They are front line. They know exactly what's happening and how they're trying to prepare to survive. And they've all done stock splits in the middle of this year. And to think that this middle of this year was going to be the worst of it is not. There was no pivot expected for a while. They would have done the stock split a lot sooner had they seen it coming this past year, and it hasn't. So there is a bigger move everybody is anticipating. So you have to understand is institutions and companies are anticipating a bigger move. Anything better than that, this is why expectations are dirt low. And if it's better than that, people are really jumping on that because it's okay, well, we're expecting a lot worse than what it is. And so hopium is very potent. So you do have to be careful for that side as well. But being said, I still think there's still one more bigger foot that needs to drop. And we have to understand that there is a crisis on our hands that is going on with the bonds, with what's going on in homes right now. And that consumer, we have to see something big could break there. And that's what I'm waiting for. When that breaks, either one, you're going to get a crash, or two, you're going to get a couple of huge more selling days. And I think that will be officially the bottom from that point. I think at the same time, the timing of when the Fed stopped raising rates will be at the same point. Now, the Fed are leveraging a lot of the problems that are going on right now and are very much in control of what's going on with the issues that we currently have. Now, if the Fed just yesterday turned around a pivot, we could go back to all-time highs, and I would believe we would go back to all-time highs. And that's what everybody was anticipating, is that we would just pivot. And I thought it was potentially a possibility. But again, you have to wait and see. And that's what I talk about. You have to be able to be flexible to play both sides. And it was close that it was possible. But then again, after the last meeting, the Fed made it clear that they will hold the policy for an extended period of time. So again, Apple, if we do start to rally, again, by all means, you got to keep an eye on this trend. If we do start to get in Christmas mode, or Christmas earnings rally, or the holiday rally here, or the Santa Claus rally, whatever you want to call it. So I do expect we could pop up to 173 if we do start rocking and rolling. Again, we want to wait and see if it does hold the 130 on that one there as well. BA, again, very overextended. You want it to break the 200 to keep going. Again, I don't like these parabolic moves with no touchbacks on old breaks. Again, that just means you're going to get a bigger move to the downside when it does happen. Again, value has been a big play that's held up the market in general, because tech is just taking an absolute beating. So value did sell off pretty heavy Thursday, did try to hold. So Tuesday morning is going to be interesting to see how that does play out. So I definitely want to keep an eye on that. And then we got JPM. JPM is going to be very interesting. Again, we do not want JPM to break 129. Again, we're going to get a bigger gap drop down on this one. I think you get a bit of a bounce off of the 124, but I think you'll ultimately find yourself here at the 116 for the banks. I think that's going to happen before earnings. Really don't see this thing holding. I mean, they've already talked some pretty bad things. Maybe we just chop into earnings and then we find out what happens during earnings, and then that might do the be the last straw that breaks the camel's back. Who knows? But GS again, finally starting to sell off. I do expect it to hit at least the 223, the 323 here before it finds some support to either one push up or continue heading down. Bank of America essentially killed itself because of the comments about negative GDP. Again, it needs to hold the 32, but I am expecting it to come at least down to roughly around 30. I'll see what happens there. And again, if earnings are bad or anything like that, this thing is going to break through that and make a new low. So just be mindful of that. Again, credit cards are going to be extremely important to watch on this earnings. Tech, I'm really not expecting much from tech on that aspect either. The continued layoffs, I think, in forward guidance are going to be extremely important coming into the earnings. Again, they're going to, again, expectations are really low. So if they hit expectations, people are going to see that as a positive. So also keep that in mind. If they get worse than what is expected from the dirt low expectations, then that's going to be a problem. And so that is something to really look at. And again, if big tech gets another bad earnings, we've seen a lot of cracks and foundation cracks over the past two earnings. If they announce something really bad, especially your Apples and Teslas that are taking massive beating, that is definitely not going to be good. You can get crushed pretty hard off that, so definitely keep that in mind. But with that being said, go ahead and drop a like if you made it this far. I do appreciate you. And until next time, have a good one, and I'll see you guys later.